Okay, this is a portfolio final presentation by Edwin Young and Barrett Foley. All right. In 2000, to economic forecast, in 2020, many areas of the economy have been hit hard by the effects of the COVID-19 virus. As the 2020 is coming to a close, many areas of the economy seem to be rebounding slowly, giving investors hope for the future. The economy will eventually improve, but will not make up the loss from early this year. By 2022, the economy should get back to full normal levels that were seen before COVID-19 came to an effect. Group risk profile. As taken from Project 2, our group average risk tolerance is 29.5, which is above average tolerance for risk. Our group is willing to step out of the comfort zone and invest in areas that react to the market and economic trends strongly. Based on our above average risk tolerance, we would heavily invest in stocks. Because of the current market situation, we will consider a mixture of stocks, bonds, and funds. Our perspective on market efficiency is our group believes that as of now, the current market is not efficient due to the health crisis of COVID-19 and its effects. Due to inefficiencies in the market, many prices for stocks, bonds, and funds are down right now. Given this information, I believe that the market will return to its efficient levels in the near future. Now is a good time to invest long term. The objectives. Okay, given that our group has $100,000 to invest, we expect the following to occur with our investments. Increase the value of our portfolio by $1 million. The amount of time that it would take to increase our portfolio to its target goal would be 30 years. In order to reach the goal of increasing our portfolio by $1 million, our target annual return would be 8%. Okay, our asset allocation. So our group decided that we will invest all $100,000 in 2 stocks, 2 bonds, and 2 funds. How will we allocate the $100,000? Well, the 2 stocks we will allocate will be in Target, which is 128 shares at 171.34, and the other stock is Microsoft, 141 shares for 211.44. And then we have our 2 bonds, Schwab Charles Corp, 94 shares for 108.71, and Berkshire Hathaway FinCorp, 111 shares at 98.98. And then our 2 funds will be Northern Stock Index Fund, 309 shares for 42.17, and then American Funds New World Fund at 165 shares for $84.82. Okay, here is a graph of how we're going to allocate our stocks, bonds, and funds. And you see here where Target and Microsoft make up of 52% of what we're investing, and then the rest you see, going to the bonds and funds. Profitable industries. Sectors that will be profitable in our short-term economic forecast are consumer cyclical, which COVID-19 affected most sectors in the short term, but the consumer cyclical sector has rebounded since the company has opened up and is performing way above the index in the short run. Sectors that will be profitable in our long-term economic forecast are technology, healthcare, consumer defensive. Technology, healthcare, and consumer defensive all had a potential to see massive gains and trend upwards in the market in a few years, according to the last reports for each on Morningstar. Our first stop, Target Corporation. The key ratios. The current ratio, you see our firm, Target, is at 1 compared to the industry at 1.33. The quick ratio, our firm is 0.40 compared to the industry 0.60. And our debt to equity ratio, Target 1.1 compared to the industry 0.88. Some more key ratios are return on assets. Target is 8.10 compared to the industry of 9.09. The net profit margin, the firm is at 4.31 compared to the industry at 5.63. And the dividend ratio, we targeted at 1.51 compared to the industry at 1.26. So looking at all the key ratios, our stock is running close to the industry. Our stock valuation, the PEG ratio, the firm is at 1.75 compared to the industry at 2.17. The price to earn ratio is the target is 22.83. Our firm compared to the industry at 23.71. And then our price to book ratio, the target is 6.85 compared to the industry at 9.97. And then our price to free to cash flow, the target is 23.69 compared to the industry at 19.96. All right, the catalyst with our target, what we make things the stock might rise is Target expects to expand its ship same day delivery service from 700 stores to 1,000 stores in the second quarter. Drive up pickup service is offered at 250 stores and will be expanded to about 1,000 stores by the end of the year. Target now offers next day shipping and free 2-day shipping nationwide for orders of $35 or more. So with these 3 catalysts, we think the stock has a potential of going up. Target expected return. The future target price is 111.70. The target current price is 172.40. So the expected return, we divided future target divided by current price minus 1. We have our expected return of a negative 0.35, which the stock, you see where the future target price is going down, but we still think that it will still be a good buy with the stock going low and just buying into it and hoping that the stock goes up. But it's still a good buy to buying at a low price. Other stock is Microsoft Corp. And their key ratios, the current ratio, Microsoft 2.53 compared to the industry at 2.38. The quick ratio, Microsoft at 2.30 compared to the industry at 2.29. And the debt to equity ratio, Microsoft 0.53 compared to the industry at 1.21. Other key ratios for Microsoft, return on assets, Microsoft 16.38 compared to the industry at negative 3.53. The net profit margin, Microsoft was at 32.39 compared to the industry at negative 4.56. And the dividend yield, Microsoft 2.04 compared to the industry at 4.9. The valuation for Microsoft, the PEG ratio, Microsoft 2.34 compared to the industry at 2.65. The price to earn ratio, Microsoft is 33.34 compared to the industry at 291.35. The price to book ratio, Microsoft 12.9 compared to the industry of 16.93. And then the price to free to cash flow ratio, Microsoft 46.9 compared to the industry at 81.68. the catalyst for the Microsoft Corp. Short term, the growth of its overall cloud business, video games, Teams, and the work from home trend will drive the stock higher. In the long term, the company is launching new cloud-based products tailored to the needs of the sectors that are most likely to be successful. Microsoft expected return. The future target price is 239.44. The current price is 210.52. And then we expect expected return to be 1.14, which is a positive. And this is showing that this stock is in good shape and it's a good stock to invest in. This concludes my part of the presentation, and the next slide will start with Barrett. Thank you.
My name is Barrett Foley, and I'm going to be talking about the first bond we chose, which was Schwab Charles Corporation New. So this bond is a short-term callable bond that matures in 3/10/2025. The issuer of this bond is Charles Schwab Corporation, and the price sits at $108.71. The Moody's rating as of 11/26/2019 is an A2, which means this bond is high quality and has a strong capacity to meet financial obligations, but it's also somewhat more susceptible to the adverse effects. The S&P rating as of 3/10/2015 is A, which is basically the same thing as the A2 Moody's rating. So the issuer current debt, as I said, the issuer is Charles Schwab Corporation. It has a total debt of $7.84 billion through Q4 of 2020 so far. And as you see below, there's the debt levels for 2019, 2018, and 2017. The debt to equity ratios can be found on the next slide within the graph on the right. As you see here, this is the kind of the performance of Charles Schwab Corporation as a whole. On the left kind of shows the levels of the total debt, 2017 through 2020, and on the right shows the debt to equity ratios. The current is 0.25, which is ranked higher than 53% of the companies in the capital markets industry. So the type of coupon this bond pays is semi-annual at a fixed coupon rate of 3%. And the bond pays $13.68 in each period, and interest is each period. And given that this bond is a short-term bond that matures on 3/10/2025, there's little risk of interest rate fluctuation playing a big factor in bond price when compared to a long-term bond. The next bond was Berkshire Hathaway FinCorp. This is a long-term callable corporate bond that matures in 1/15/2049. The issuer is Berkshire Hathaway Incorporated, and the price hits at $98.98. The Moody's rating as of 1/3/2019 is AA2, which means this bond is very high quality and has very low credit risk. The S&P rating as of 1/3/2019 is AA, which means essentially the same as the Moody's rating. The issuer is Berkshire Hathaway Incorporated, which has a total debt of 107.69 billion so far through Q4 of 2020, and you can see the total levels from 2019, 2018, 2017. And debt to equity ratios can be found on the next slide as well, on the graph on the left or in the middle. As you can see here, here's a debt to equity ratio. The current is 0.26, and the average is 0.24. This debt to equity ratio is ranked lower than 54% of 349 companies within the insurance industry. So this bond pays semi-annually at a fixed coupon rate of 4.25%. And given that this bond is a long-term bond that matures on 1/15/2049, there's a definite risk of interest rate fluctuation over this long period of time. This possibility of interest rate fluctuation can negatively affect the price of this bond and can potentially result in lower yields than expected. So the first index fund that I chose was the Northern Stock Index Fund, NO6. So relative to Morningstar category, this fund's returns over the past 10 years outperformed every year by a good margin. And it also, according to the information on Morningstar, this fund on average has an average risk but an above average return when compared to its category and has a very diverse fund allocation. Below you can see the standard deviation and Sharpe ratios for 3, 5, and 10 years, and these are all compared to the category and index as well. When researching the Sortino ratio, I found out the 3-year is 0.49, which is lower than the 3-year Sharpe ratio, which is seen on the previous slide. And fund composition has been seen in this chart that I'll show you in the next slide. This fund is very well diversified within the different sectors. Its biggest fund composition is within the technology sector, taking up 24.69%, and the second biggest is within the healthcare sector, taking up 14.33%. And according to Morningstar, this fund's historical expense ratio for the last 5 years has been up 0.1% compared to the category average being 0.911% in 2020 and comparison group being 0.84 in 2020. As I mentioned, here's the performance on the left. It shows you the fund percentages throughout the years, 10 years, compared to category and index. And on the right is the allocation of the funds. As I mentioned, technology and healthcare are the two biggest ones. The next fund that I chose was American Funds New World Fund Class A, New FX. So relative to Morningstar category and index, this fund's returns over the last 10 years outperformed in most years, but underperformed in 2010, 2014, 2016, and 2017. And according to Morningstar, this fund on average has a low average risk but a high average return when compared to its category, which fits into our risk. So our standard deviation and Sharpe ratio as below can be seen 3, 5, and 10 years, and these are all also compared to the category and indexes as well. Sortino ratio 3 years 0.67, which is higher than the 3-year Sharpe ratio, which is seen on the previous slide. This is a mixed fund with international exposure. So 70% is in non-US equity, but only 21% is in US net assets. And as Morningstar suggests, this fund is primarily diversified in companies that have large growth and are generally overseas. As I said, 70% is overseas. And the largest fund composition is within technology, which is, picks up 17.56%, followed by financial services at 15.25%. And below you can see the fund expenses, the historical expense ratios, and then the category averages. And these are some more charts. Like on the left is the growth, so total return percentage, category, index. On the right is the fund allocation. So managing portfolio and our conclusion. So in order to manage our portfolio, we must first monitor key ratios, read expert analysis, consider possible future catalysts, reinvest our dividends, then rebalance portfolio by adjusting monetary stake in each category, to reflect the original percentage. And then we also must pay close attention to market trends, shifts in the economy, changes in the political landscape, and news that affects companies. And finally, attend stockholder investor meetings. And by doing this, I think it's a good way to manage our portfolio and keep it on top. And that is it for our final presentation. Here's our works cited. Thanks for listening.